What happened in the last 10 days that everyone's freaking out about, 47,000 down to 38,000, really has nothing to do with GBTC selling. It has nothing to do with, people freaking out. It's just simple supply demand dynamics. You have the normal selling that goes on this time of year every year with Lunar New Year coming up. So Chinese sell a bunch to fill up the red envelopes with money. That's normal. But then we have another one that happens right before tax time in the US. The second thing is you had the liquidation of the FTX $1 billion of GBTC.
Over the past couple of weeks, expectations following the SEC's historic approval of 11 spot Bitcoin ETFs have been upended. While many anticipated immediate price gains, the reality has been quite different. On the first day of trading, Bitcoin surged to $49,000 per coin, a 2-year high, only to face a sharp correction almost immediately thereafter. Prices plummeted below $39,000 for the first time in nearly 50 days, prompting widespread speculation about the reasons behind the downturn. Some, like senior Bloomberg ETF analyst Eric Balchunas, attribute the decline to massive outflows from GBTC. However, renowned hedge fund manager Mark Yusko presents a contrasting perspective. According to Yusko, a significant portion of the outflows from GBTC are flowing into other Bitcoin ETFs, minimizing the actual losses. He believes that the outflows are likely to taper off soon, especially since investors exiting GBTC are primarily using tax-exempt accounts, mitigating the impact of high fees. Yusko's insights have sparked discussions about the future trajectory of Bitcoin and cryptocurrencies. In a recent interview with the 3T Warrior Academy, he delved into the factors driving the recent price fluctuations, his expectations for the crypto market going forward, and the evolving role of ETFs in this landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
There's a demand shock going on. So you got aggregate demand, aggregate supply, and we're shifting the demand curve up. Why? Well, $30 trillion controlled by advisors just got unlocked, but it didn't, because Vanguard, UBS, and Merrill, Bank of America, said, no, you're not allowed to buy it. Isn't that my money? Aren't those my assets in your brokerage account? So I hope everybody flees Vanguard and UBS and Merrill, because that's stupid. It's our money. But you're telling me I can't buy this. So it's not going to happen overnight. And let's say that a year from now, those models, UBS, Merrill model, says 1%. Let's say you do 10 basis points, 20 basis points. We're talking $30 to $60 billion of demand. So if you shift the aggregate demand curve, P1, okay, where price and demand, supply and demand intersect, is higher than P2, P0. P1 goes up, price go up. Then you got a supply shock, and the supply shock is really simple. If you cut the block rewards in half, which to me was one of the great engineering coding ideas really ever. And that's a big statement, but here's what it is. And we've talked about this before, and it's a little bit sexist, but what is. Here's the thing. You cut the block rewards in half. So what happens? Unless price goes up, half the miners would be out of business because their costs are fixed. So the price starts to rise. Well, as the price rises, us guys, we have hunter in our genes, right? If someone walked by my office, I would look. If it's moving, we like it. If it ain't moving, we can't see it. I've told you the ketchup thing. My wife says, get the ketchup. I open the door. Honey, there's no ketchup. It ain't moving. I can't see it. So since most of the traders happen to be guys, price starts to go up, the traders, they start buying it. And that creates number go up. And so the fair value basically doubles. So we've got fair value of Bitcoin today about 50. We end up about 100. Now, that's in a world with no transaction fees. Now transaction fees are rising because of inscriptions and ordinals. So maybe we don't go from 50 to 100, but let's say we go from 50 to 80 for fair value. And Tim Peterson has this great Metcalfe's Law model that can give you that number. Well, at 40, we're well below 80. So number's going to start to rise toward 80. But then what's going to happen is you're going to get this demand shock on top of the original demand shock, which is the FOMO, right? The traders are going to come in, they're going to say numbers moving, and then the speculators and the gamblers come in. Then they start levering up. And so in every crypto fall, right, we're in crypto summer right now, crypto fall starts in June. In that June to June period following the halving, we get these parabolic, stupid rallies. And we go on average to 2.3 times fair value. So last time fair value was 30, we got to 69. This time, I don't think we go to 2.3. I think we probably don't get as much leverage in the system. So let's say we go to, let's be conservative, go 1.5. If fair value is 80, we go to 130, 150, somewhere in that range. That's going to happen. And when it does, the FOMO will draw in a lot of weak hands. And then ultimately the bubble will pop and we'll have another bear market. But that's, a year from now.
Mark's forecast for Bitcoin during this bull market is straightforward. He anticipates a gradual ascent towards fair value, which he pegs at around $50,000 per coin. This climb is projected to persist until the halving event. Following this, Mark envisions a brief sell-off phase, signaling the transition from crypto summer to crypto fall. However, it's Mark's outlook beyond this point that captures attention. The Morgan Creek Capital founder foresees significant parabolic movements between June 2024 and June 2025. Even with a conservative stance, Mark is confident that Bitcoin will surpass its previous all-time highs, potentially doubling its current peak. During discussions with Gary Cardone of Card1 Digital Ventures, they explore the nuances between self-custody and investing in Bitcoin ETFs, scrutinizing whether ETFs introduce centralization risks for Bitcoin.
Owning Bitcoin through a centralized entity, Coinbase, Gemini, ETF wrapper, you are to the maxis, right? You're antithetical to what Bitcoin is supposed to be. Bitcoin is supposed to be on your, ledger or on your, cold wallet, and you're supposed to have it and, pry it from my cold dead hands, right? Okay. Decentralization, superior. I agree. But here's the thing. The technology is not perfect yet. And meaning in the sense, it is perfect in that it works, but it's complex. And there are people that lose their keys, they forget their password. Stuff happens. So we're not going to go from TradFi, where everything's centralized and everything's run by big banks, to DeFi overnight. We're going to have a CeFi type. And that's what's been happening. Coinbase, Cash App, Strike, Jack Mallers, right? CeFi. Eventually, everyone's going to be DeFi. You, 25, 30, 40, great. My dad, 85, never going to hold his keys. Not ever. I'm not going to hold his keys because if I lose them, then I'm, in trouble. So he's going to have Coinbase. He's going to be centralized. I had lunch with a friend, or breakfast with a friend of mine today. He's like, hey, should I just buy the ETF? Yes, you should. 65-year-old guy, you should just buy the ETF because I don't want to explain to you how to get a ledger and how to, save your seed phrase. So yes, but it doesn't centralize the system. Everyone's saying, like Max Kaiser. Well, they're going to seize all those Bitcoin. Oh, okay. So let's say that this happens. Let's say that the ETFs gather 25% of all the Bitcoins. It's possible. Let's say that happens. They get 25% of all the Bitcoins. And Ms. Warren gets a law passed that we, the government, through eminent domain, is going to seize them in the issue of national security. Illegal, but okay, fine. She gets it done. What happens? Is suddenly Bitcoin out of business? Suddenly, is it over? No, it's better. That 25% gets lost or stolen. The other 75% rises in value. Satoshi said at the very beginning, he said, yes, coins will be lost, coins will be stolen. Consider it a contribution to the network. And so as long as there's one Bitcoin, which can be divided into 100 million Satoshis, as long as there's one left, it exists because it's infinitely divisible. And I feel sorry for Samantha Dulac. She's actually a very nice lady, But she made the comment about, well, I don't understand, if it can be divided into satoshis, then you can have unlimited supply. And cut the pizza, like you can cut the pizza into 1,000 gazillion pieces and feed the world. No.
The future, I don't mean to make the macro guys or the maxis really upset, but you're not going to store $50 million on a fucking wallet, guys. That's probably going to change in the next 10 years. We will laugh at the wallets we have today. Absolutely laugh. And like, I technologically am not sophisticated enough to look at one of these ledgers and go, am I sure there's not a bug in it? Like, I would rather be able to sue a major bank. Okay. Like, the ETFs are going to suck this stuff up. And like, the self-custody for me, I got it. Mad Max, I'll take maybe $500,000, stick it on to be able to self-custody. But like, you start talking about $100 million. What happens if I go into a coma? What happens if
type the wrong address?
Somebody walks into my house, guys, and sticks a gun in my daughter's throat and says, "Hey, dude, I need the seed phrases right now. I'm going to surrender. I will surrender this second."
There's been significant buzz surrounding Bitcoin ETFs, yet many crypto investors, particularly Bitcoin maxis, remain skeptical. They argue that while ETFs provide a convenient entry point into the crypto market, they inherently centralize a space built on decentralization. Furthermore, ETFs lack the foundational benefits of cryptocurrencies and fail to attract new users to the ecosystem. Conversely, proponents like Mark and Gary contend that self-custody isn't as accessible or realistic as commonly thought. They argue for the necessity of ETFs, especially for older investors, believing that the benefits outweigh the risks. However, some remain staunchly opposed to the idea, citing concerns about centralization and the track records of firms like BlackRock. Where do you stand on this debate? Do you believe ETFs are essential, particularly for older investors, or do you oppose them due to their centralized nature and the history of certain firms? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.